All good.
How's everybody doing today? Well, first and foremost, Ali, thank you and the Global Good Fund for inviting me to give a little talk about finding investment capital for companies. I'll start by introducing myself. My name's Mike Leffer. I'm a principal and member of the founding team at Squadra Ventures, which is an early stage VC fund based in Baltimore. I am also a 2019 Global Good Fund Veteran Fellow. And the presentation today is, like I mentioned previously, to help entrepreneurs understand what different types of investors look for and how to go about getting early stage funding. So before I dig into the meat of the presentation, I just wanted to start by telling a little bit of a story about Liza and Erica. Liza and Erica on the screen are two super impressive military spouses and the founders of a company called Instant Teams. And what Instant Teams does is place high-performing military spouses into customer support roles at large companies. And we invested $1.5 million into their company at the beginning of this year. And what's interesting is their story and their process about fundraising. And I was actually introduced to Liza and Erica last year through a close mutual friend. And from that introduction to the point at which we invested took approximately 6 months and many calls and Skypes and questions and memos and this big back and forth. And for Liza and Erica, the process started long before they got to me. It took them in total about 12 months to raise the capital, and it took them maybe over 100 conversations with different investors. So I'm telling you this because, you know, when someone sees the news publication about so-and-so startup raised money, kind of makes it sound easy. I want to validate and say it's like exceptionally hard. It's not a cakewalk and it takes a long time. So now I'll start to talk a little bit about the different types of investors you might find in the ecosystems. And I'll start with angels. So angels are all high net worth individuals. And this is a definition that's given by the SEC. So it's over $1 million in assets or a certain salary threshold you have to meet for multiple years in a row. And what's interesting about angel investors in particular is that they're investing in startups and companies for a variety of different reasons. Some care about economic development and job creation in their local area. Others care about specific technologies that they're really passionate about. And frankly, others care about making a lot of money. So what's interesting about this is you can really hone in on which angel investors fit what you're doing, and that's how you go about targeting them. And some of the easiest ways to find angel investors: going to local technology events, networking events, pitch competitions, incubators and accelerators. And they're always wandering around and you can find them. This is angel investing by the numbers. So there's hundreds of thousands of angel investors in the US, and they invest a lot of money into early stage startups. What I find interesting, or most interesting about these stats, is most of the folks who are angels previously founded or ran startups. What's still unfortunate and is not necessarily happy news is that most of the investment dollars don't go towards diversity, inclusion, or impact investing, though hoping this trend will change going forward. One fact that's important to ask yourself when you're looking for angel investors is, do you want investors who are helpful, or do you want someone who's just going to give you the capital and let you run your company? And either answer is okay. There's no good, there's no bad here. But if you want someone who's going to be helpful, it makes sense to target angel investors with entrepreneurial experience because they take more active roles in portfolio companies historically. Now, on the other side of the table, you've got venture capital investors. And this is a picture of us at Squadra VC. VCs are professional investors that raise money from high net worth individuals, pension funds, foundations, limited partners, and then invest that money into startups on their behalf. I will tell you this so there's no confusion. Despite what any website or mission statement tells you, the number one goal of a venture capitalist is to make significant returns. And VCs look for each of their investments to be able to yield at least a 10x return on their investment. So at the end of the day, it's smart money, but they really do have high expectations. Here's VC by the numbers, just to give you a sense. So there's a lot fewer venture capital funds than angel investors, but they are deploying significantly more money overall. And the check sizes and deal sizes are much, much larger. One interesting stat here is since 2009, there's been a lot more funding in female-founded companies, and this sort of correlates with the overall sentiment of the rise of impact investing funds. So there is opportunity out there for impact-focused VCs, but they still do care about returns. And why do VCs invest in startups? As I mentioned, to make returns. And how do VCs make returns? It's all about when the company sells 5 to 7 years, 10 years after the investment. That's how they get their 10x on capital. Dividends, cash flow, returning the investment piecemeal is not what venture capital investors look for, because historically that's not how returns are generated. It's investing in a high growth company that goes from a $5 million valuation to a $1 billion valuation. And that all has to do with the success rates of startups. And I'm happy to dig into that a little bit more later. So this is the venture capital and startup life cycle. I get asked a lot, hey, Mike, I've got an idea, or I'm a pre-revenue company. How do I raise angel investor or venture capital money? And it's unfortunate, and it's not a hard and fast rule, but what I'll say is 99% of the time, if you're a pre-revenue idea stage company, it's going to be exceptionally hard, if not near impossible, to raise venture capital dollars. And usually the only exceptions to raising venture capital pre-revenue is if you are a founder or entrepreneur who's successfully started and sold another startup that has made investors money, or you have some proprietary deep technology that's so defensible that it makes it attractive to folks who place many different bets in high probability technology. That's not to say there's no investors who will invest pre-revenue. Angel investors are more likely to invest at the stage where you have like a product or a prototype, you just haven't gone to market yet. But at the end of the day, you're going to be frankly beating your head against the wall, trying to raise money instead of spending time building your company. So now, I've told you what investors look for at what stage and how they work. I can talk a little bit about what investors care about when you're having a conversation with them. When investors are assessing your company, there's many things that are table stakes or you absolutely need to be able to discuss. So what is the problem you're trying to solve? What is your solution and how does it work? How big is the market and how big can your company become? What's the competition like, the valuation, et cetera? And one thing to note is that while there's some topics that all investors care about and need to see, each investor, each venture capital fund has their own thesis. So they might care about some topics and weight them more heavily, or have some additional information that they need to see from you. So for example, at Squadra, one of the most important criteria for us is the team. And the team means a few things. One, we really don't like to invest in solopreneurs or single founders. We like to see multiple founders or teammates around the table. We like to see that they're experienced and deeply passionate about what they're doing, and that they are self-aware enough about their own limitations to know what they need help with. We also invest in the plan. And what that means is the founders coming to us with a plan for the next 90 days, a plan for how they're going to triple the size of the company in the next year, and how they're going to 10x the company in 3 years. And while the only thing we know is 100% certainty is that plans will change, having this mental exercise done and a plan in place is deeply important to our fund. And then third, because of the way we at Squadra work with companies, we roll up our sleeves, we're hands-on in the business day to day. We need to assess and make sure we can have a strong relationship with our founders, and that they're coachable, and that probably most importantly, they want an investor who's helpful and hands-on. And what this means, to back up a second, Squadra is different than Andreessen, who's different than Early Light Ventures. Everyone's got a different thesis. So you have to pitch the basics, and then you have to pitch and tailor your pitch to what that investor cares about. On the flip side of the coin, it's not just the fund who's doing some analysis and diligence into your company. I highly recommend, strongly recommend you do the same and assess the fund. And it's important because if you don't have alignment with your investors, it will certainly create conflict down the road. And I've got many horror stories I could dive into about the deal was rushed to get done. It closed too quickly. And then 2 years down the road, they realized the founders wanted one thing when the investors wanted another. And it led to some big, hairy legal issues. So what I recommend founders do, ask the VCs, what was your most recent investment? Why did you invest? How is the company doing? How have you been helpful? And all of these questions are tailored to assess the relationship with the VC going forward. And in addition to this, I would 100% recommend reaching out to the founders of the companies that these folks have already invested in. And you can look this up on LinkedIn, Google, and just cold reach out, because other entrepreneurs aren't going to sugarcoat it to you, especially if they've had a terrible time with their investors. And proud to say you can reach out to any of our founders, and they'll walk you through some of the cool stuff we've done for them. So back to what should be in your specific pitch, just digging in a little bit deeper. How I like to think about the problem is, can you quantify how big of an issue this is to your customer? How much money is a company losing because of the problem? How much revenue aren't they generating? Quantification is really important, and translating it into a dollar sign. It makes it easy for someone like me who's not as smart as you and whatever it is you're doing to understand it. The solution, it's really what your company does, how it solves the problem, and how you do it. Market means if everything goes right, what's the maximum amount of revenue, or likely maximum amount of revenue you could do per year? So maybe you're doing $100,000 a year now. If you own the market, you could do $100 million a year in revenue. Talk about who else is doing it, and then how what you're doing is unique and potentially proprietary. talk about the value you're providing to your customer and how much traction you have, which just means customers and revenue. And then your team. So why are you the best at what you're doing? And as I mentioned, Squadra has some additional stuff we ask for. So we talk about the plan and how you're going to go to market, how much money you're raising, and what you're going to use it for. And then most importantly for us is how can we be helpful to you? And different firms weight some of these differently. So you'll end up spending time customizing your pitch deck to the different firms or angel investors you're targeting based on what they care about. So here's the cliche, but very real statistics about startups. Most startups fail, and of the 10% that don't fail, most don't yield like those really sexy billion-dollar venture backable angel investor returns. So when you're pitching, the whole trick here is to explain to the investor what you're going to do to beat the odds, and that's really important to having a concise and clear story throughout your pitch. So what I'd like to do now is just leave a lot of time for folks in the audience to ask questions. Ali, how do we want to?
Yeah, anyone can, everyone is on mute right now. So if you do have a question, be sure to unmute yourself and then go ahead and ask.
So Mike Patrick Alcorn here in Dallas. Thank you for what you shared with us. In the chat, I sent you a private, I think I sent it to the right person, but I sent you a private chat with a slide on it that kind of depicts what our understanding is of the capital as it relates to startups out there. So the question that I have for you is, who should truly be looking at VC as a source of capital versus all the other sorts of capital? If you want, I can put that slide up so everybody will know what it is that I'm talking about. Or you could put it up because I sent it to you. But it's actually a slide that shows that only when it comes to the startup community, only about 1% of the capital in the startup community comes from VCs. That startups really get their money from all these other different sources of funds, and only about 1% of the funds that show up in the startup community come from VCs. So that caused me to have the question: how does someone become part of that 1% that's getting their money from VCs, since 90% of the money's coming from somewhere else?
Yeah, Patrick, that's really a great question. I appreciate you asking it, because that was the point I was going to end the whole conversation with. Is before you go spend your time chasing down and trying to reach out to VCs, you have to ask yourself, does your company hit the criteria to be a venture backable company? And I haven't seen the slide, but I can talk through it a little bit. Happy to share it afterwards. But what a venture backable company means at a high level is your company is going to grow fast over the next 5 years and can 10x to 100x the valuation in a very scalable, efficient, and high margin manner. So often, and this is just a generalization, services businesses, product companies, consulting companies, engineering firms, most of the companies in the US aren't eligible for venture funding because they can't generate those high returns that I talked about earlier. So, when I look at a company, if I invest in it at a $10 million valuation. If there's no clear path to becoming a $100 million, billion-dollar company, that automatically disqualifies it from venture funding in general. So if you're honest about what your company does and if it fits that profile, that's step one. And Patrick, you asked specifically about how can I potentially turn my company into a venture funded company?
Patrick, I think you're muted.
You actually answered my question. My question was, how do I determine if I'm a company that needs to seek VC capital versus all the other sources of capital that are available out there? And so you actually answered my question. Thank you.
Great. Yeah. And, I'll add on to that a little bit. No one needs venture capital money to grow a really big business. A lot of companies grow into big businesses without venture funding. So, some folks try and raise capital because it's like a badge of honor or some validation. But what that ends up doing is it puts constraints on to how you can grow your company, and it kind of boxes you in, because when a venture fund invests in you, we often take board seats, we put controls on sort of the actions that the directors can take. And like I said, the expectations are much higher. So the goal is sometimes grow a company 100, 200, 300% a year over year with venture funding, or bust. And if you can't do that, then the VCs might forget about you or not do what's in your best interest. So, it's often better not to raise venture funding and build like a good company on your own and just use other financing sources if they're accessible, like SBA loans, Kiva lending, or bootstrapping it, or friends and family if that's accessible as well.
Yeah, hi. So I
Hi.
have two questions.
Yeah.
One is so this is like 2 years ago when I was at a point in time I needed desperate funding for the business. One of the impact investors told me that we cannot fund you because you're too niche and there is no reference model for your business because no one has done it before.
Mm.
So, that was the reason that was given. What are your thoughts on that? Why would they do that? Because it's an opportunity for them as well, somewhere, because it's a new territory. So just to give you a background, I represent a company called Planet Able, which provides accessible travel solutions for people of all disabilities.
Got it. So investors, and thank you for asking the question because it's important. Investors will say it's too niche, or investors will say it's too niche often when they don't understand the potential of the market. So there's, for example, when Uber initially started, they were turned down by hundreds and hundreds of investors because everyone said, oh, starting a high-end taxi company is a really niche and small market. It took them, one, to find a few investors who were comfortable with the fact that they could take a bet on the company expanding into something much bigger. But I'm sure it came down to how well they told the story about, yes, we're starting with black car service in San Francisco, but this can revolutionize transportation in general because we can do this gig economy for everything. So I guess it comes down to two things. One, it's is there actually a big picture vision about how this could become a really, really big company that does hundreds of millions of dollars a year in revenue? And if there is, it's, maybe your pitch just needs a little bit more work to get that and show that progression from, yes, we're starting small in this niche here, but with your capital and expertise and help and advice, in 5 years, our company is going to be here doing exactly what you want. So that's part of it. The other part is some companies are so highly focused and small, and they're serving industries that maybe max they can have 1,000 customers and do a few $1 million a year in business. If there's no secondary market or easy path to expansion, then that isn't a venture backable company, because there's no way I could invest in your company at a low enough valuation to get a 10x return, because that's just the way sort of acquisitions and in the world works. And we don't want to take all of the equity from your company because it's your company. Does that make sense?
Yeah, sure. I mean, so I think it was fortunate that they didn't invest, because the next year we grew 7 times. So that was good for us. And then investors reached out towards the early start of this year. But of course, with COVID, everything has gone bust. They have put everything on hold. So the another question that I have is, should you choose to bootstrap and grow slowly over the years, or you should take advantage of the first mover advantage and take the funding and scale faster? So, I mean, how do you make that choice?
Yeah, it's a really good question. And I would 100% be lying if I told you that I could sort of lay this black and white answer for you. It's highly dependent on your situation, and there's a bunch of different variables that you have to sort of think about and put in this equation. So if your company does, say, a piece of communication software or tools, think like a Zoom or something, and anyone could build something similar without much money or cost, then that is probably going to be a game of market share, and you better go as fast as you can to get as much of the market. But if you've got maybe a little bit more defensibility, or you're so far ahead of the market in terms of timing about what you're doing, maybe the market's not ready to accept your solution, or the customers don't even know it's a problem yet, then it might make more sense to slow down and be more methodical and bootstrap it, because it could kind of lead to problems on either end, where you raise too much money at the start and the market's not ready, or you don't know how to spend it and you make wrong decisions, and then you're out of money and you have to raise more money, but you haven't hit your last goals. So then you lose more equity, or because you get diluted at a down round, or you can't raise any more money and your company fails. But on the other end, if you don't go fast enough, sometimes you miss the wave and someone else will swoop in and grab that market share, and it's too late. So I wish I could give you a definitive answer. I'm happy to talk through it with you. Is the best I could do.
Great. Thank you so much. Thank you.
Yeah.
No, I think you had a question.
I do. I don't know if my video is working here. Can you hear me?
It's working. I can see it.
Okay. Good. Well, nice to see you guys too. So Mike, thank you for that presentation. We've got so much to learn. I think all of us are in a unique position of trying to make a social impact. Well, of course, trying to build our companies. I don't know if we're necessarily all going to be unicorns, but maybe somewhere in the middle there, we can make some progress thanks to your presentation. So thanks for that. My question to you is about equity. My company has been on this investor roadshow, as I call it, for the past year. I've given not over 100 presentations, but maybe like 45. And the feedback has been pretty positive overall, but everybody's got an opinion and none of the opinions overlap. They're on a huge spectrum where most people, of course, want a lot of equity, and then they have opinions of make tons of cuts, cut to the bone with spending, versus just go all in and conquer the world all tomorrow. So I wanted to ask you about if you could share a bit about your experience with how much equity seems to be comfortable to give up. I've heard feedback saying don't be an equity hog. I've heard feedback saying you can't get it back, don't give anything. So trying to match up what we're comfortable with for giving, how to value a company is something we're really stuck on. I've tried to come up with a valuation for our company based on the research and citations that I could find, but it's all an opinion. So what input could you advise us for how to balance everybody's opinions, including our own, with how much equity might be okay to give up at a preliminary time like this for our first round?
Yeah, for sure. So I'm going to break that up into 2 questions, Noah. So thank you very much for asking this. This is amazing. First question, how much equity to give up per funding round? There's some rough number guidance where typically you can expect somewhere between 10 and 30% dilution with each funding round. It can go either way. So maybe if you've sold a company before, you can get away with raising $2 million at a $20 million pre-money valuation. Typically first-time founders more in that 20, 25, 30% range per round. But at the end of the day, I'll tell you this, investors lose when they force entrepreneurs to give up too much of their equity because it demotivates them to do well. So that's never in the best interest for the company. So if you get a really outrageous offer that says we want to buy 51% of your company for pocket change, if they're not going to run the company and pay you a salary, then don't take it. So that's part one. There's a range, it's a balance, but it all comes down to finding out what you're comfortable with based on, what I said is the plan and expectation for the company. So if you truly believe that it could be $1 billion company, $100 million company, $500 million company, even if you only have 10%, 30% when that company exits, that's still a life-changing event. And if that investment capital is going to be the catalyst to help you expand the team and execute upon that plan to get there, then the analogy, I have no idea where it came from. I'd rather have 10% of a watermelon than 100% of a grape.
So that makes sense too. I mean, considering we're all social impact entrepreneurs, maybe it's okay to end up owning 10 to 30% of a company if that helps us accomplish our mission better. That's what I try to focus on so much. But when I'm having these conversations, not everybody's as mission focused, and maybe the fun space that we're in, and it's also the confusing one. So that was really helpful. Thanks for sharing that insight, Mike.
Yeah, no problem. And just to follow up on that, the way the math actually works out for a company that IPOs, most founders typically end up with 10 to 30% of that company, unless it's something really wild anyway. The Facebooks are kind of the exceptions out there. The second part of your question, if I remember correctly, was how to come up with the valuation.
Yeah.
So investors, as an investor, I have a few different ways to value a company. I can, if you're generating revenue, go look at publicly traded companies that are in a similar space, and I can do the math about, well, if you're doing X revenue and that company's trading at 10X revenue, I can do the simple, you're valued at 10X, whatever you're making now. So there's that comparable analysis. I can go onto PitchBook or Crunchbase and look up the average or median valuation of a company in that same industry at a similar stage in my area. And that can help me triangulate the market conditions. or I can, come up with some theory in my head about, well, you've got intellectual property and it's worth $500,000 and the team's experience, so let's throw in a little bit more and a little bit more. The way I personally like to approach it goes back to a philosophy about alignment. So if I believe your company realistically can sell for $100 million, which is pretty darn good, I at least need to 10x my investment, so that the ceiling about how much I'd pay is a 10 million post-money valuation. And if it's an exit that's supposed to be less, you kind of tailor it back to that 10x number. That's what I do in my head. And the way I walk through this with entrepreneurs is, if we're not aligned on expectations for the companies and incented by having the same outcome, then if you get an offer for $100 million and I paid 50 million to get in, I'm going to apply so much pressure to get you to keep going that, and this is where it gets really bad. And that's where I've seen it break down in the past, where investors have had legal rights to block acquisitions that are below certain thresholds, and happened to a close friend of mine who started a cyber company. Fortunately, he was able to pull it off before the thresholds kicked in. So it's, what's realistic, what generates alignment with your investors so they're incented for everyone to win. And then it comes down to what's market as well. So if you're in the mid-Atlantic, in the East Coast, without a doubt, the valuation is going to be lower than if you were in Silicon Valley and on the West Coast, just because of what's market in that environment. So that's another consideration as well.
And are your multiples always from earnings, or are they ever from top line revenue? It's my last question, I promise, team.
Yeah, no. That's a great question. So in high growth software companies, the valuation multiple is typically based off top line revenue. If you're a consulting company, it's maybe 5 to 10x EBITDA or net profit. So it all depends on what the specific industry you're in and what the product you have and how fast you're growing. Does that answer your question?
Yeah, thank you.
And happy to, Noah, sort of walk through your specific case after this.
Careful what you offer, Mike. Thanks. Might take you up on it.
Too late for me. Please. Happy to answer any other questions. Don't be shy. You've got a VC right here in the audience.
Okay, so I have a question.
Yeah.
My name is Margo. I'm from Houston. I have, I guess, been in the realm of like trying to raise my first round. And I had actually met with, I guess you can say he's a financial intermediary. So he helps companies to raise money. And when I met with him, he actually had given my company a valuation of like $1 billion, just based on revenue and also the stuff that I presented to him. And after COVID-19, it really changed the approach. So the pitch deck that I was sending out to investors, I pretty much came to the conclusion that I don't think it was going to work because a lot of investors will pull out. It's a brick and mortar base. So I am now in the realm of education technology with my same programs and products. But when you have an MVP and it's already in the market, it's already generating revenue, how do you sort of pitch that to investors to where, like, I don't have the technology developed yet, but that's why I need to raise the funds so that I can develop the technology. But how do I kind of pitch that to these investors? And then if I'm looking for a certain type, how do I determine if I should go the realm of VC versus angel when I haven't? It's like I've proved my product in the market but I haven't proved the technology version of it. So I'm sort of lost in translation, I guess.
Yeah, yeah. Could you tell me, and thank you, Margot, for asking the question. Just tell me quickly what the company, the brick and mortar company, does, and then what the technology you want to build.
So I pretty much developed a franchise system, and it's like a girls empowerment space. So we're helping to increase confidence and self-esteem of girls, usually the ages of like 6 and 12. And I have a curriculum that I teach in the centers, which I franchise, but I also go into different schools and I teach the same curriculum. So now I am trying to really apply the artificial intelligence and deep learning tools to detect certain behaviors in girls and then suggest certain alternatives. And this is the data that we'll be able to give to the schools to help create safer environments and really grow the child in the sense of like social, emotional, I guess, learning.
Mm-hmm. And that's great. Thank you for sharing. I mean, it sounds like a really 100% important service and product you're providing to girls everywhere. Can you tell me, what do you think the outcome is for the technology company? Do you see a way to monetize it in the future? Is it just going to sort of...
The goal is to continue to do the contracts with the schools, because I'm contracting now with schools, and I'm just delivering the curriculum like in person or via a virtual method.
Sure.
So the goal is to do a lot of the B2B contracts with the schools, and then also have the parents to subscribe to the app so that the kids can work on this stuff at home as well. Yeah,
makes sense. From the investor perspective, and I'm certainly not alone in this when I say it's possible to transition like a services or a brick and mortar company into a product company, but it's easier for an investor to just wait around until we see you've actually done it and had some traction with the product before we invest. So my gut feeling is here, it's going to be hard for you to go raise venture capital money until after you've proven out the deep learning and machine learning aspect in software. So without knowing anything more about like the cash flow of the business or how the eligibility for other types of funding is, like, it's always best if you could find a developer to sort of build out the prototype and finance it yourself through either, like extra cash you're making from the business or maybe a small SBA loan. And once you build out that product that angel investors or VCs can see that is software and tech, that's when they'd get excited and potentially invest. Or I don't know if you could find a software developer or an engineer who's passionate enough about what you're doing to basically work for equity and join your team for free. Did that answer your question?
Yes, that definitely answered my question. Thank you for that.
Yeah. It sucks being told you're not going to be able to raise any money, but I'd rather pull the Band-Aid off.
No, I would rather like learn the truth, because honestly, when I was sending the pitch deck out to companies, I would secure the meetings and they were very interested in learning more about the company. But then when it got ready to like move to that next phase, they're like, okay, well, it doesn't seem like the right model for what we invest in. So that's like where what my barriers were to really raising the funds.
Did they tell you what they meant by not the right model?
Well, one of the Southwest Angel Network, they actually reached out and they were like, he's not used to working with franchisors. So he wasn't familiar with that realm, even though the traction was there. The one
Yeah.
center that I do have is done really well. He wasn't familiar with the franchisors. And then another investor I reached out to, she was really eager to invest, but they only invest in like the southeast region, so like Louisiana, Arkansas, and I'm in Texas. So I fall right outside the border, so we couldn't do anything with that either.
Well, I mean, that's really interesting. Have you looked up on Google investors who specifically focus on the franchise model?
No, I have. That was actually my next phase to do, was to look up just franchisor investors, because I ran out of capital, and I know I have a good model, and it works. It generates revenue, but it's also making a positive social impact in the communities that it's in. So that's actually that's my next thing. And I think another one of the investors I reached out to, he felt like it was doing too much because I have a brick and mortar location, and then I also deliver the curriculum to the schools. So he was like, maybe you should pick one or the other. But I'm delivering the same content. So I kind of went back to the pitch deck and looked at it from there as well.
Yeah. At the end of the day, they're all potentially valid points, but you're the CEO and founder of the company. If you feel like you can provide the service to schools and in brick and mortar and do the software, then more power to you. And don't let some crotchety investor tell you what you can and can't do. But I would say, look at the data. So for instance, we've got a company in our portfolio right now that's got 5 different business lines, and we've been invested in them for a few months, and I can start to see, well, business line 1 is doing really, really well. Business line 5, you haven't had a new customer in since we've invested, and the unit economics literally don't make sense. So please, I'm not going to tell you what to do, but come back with the analysis showing me why the hour you spend in this business line is worth just as much as the hour you spend in business line 1.
Right. And that makes a lot of sense. It makes a lot of sense. And when you put it in those terms, I'm understanding kind of what the investors are looking at when they see my pitch deck, the business lines and what they make sense to invest the time and the resources in.
Yeah, the most precious commodity is your time, because you're the one who's most passionate about the company and who has the most experience with it and is who's making it work. And if you're spending your time on something that's not going to make an impact, it's a concern. But yeah, does that make sense?
Yes, that makes a lot of sense.
Cool.
Thank
Can I
you.
ask another question? I mean, yeah, I've been asking too many, but one last one.
Oh,
Hey, Neha,
Yeah.
Ian asked a question in the chat, and I just want to make sure that we give everybody
Sure.
time to ask question. And if nobody has any questions after that, I'll pass it over to you.
Sure.
Thank you. I appreciate that. Anne, would you like to go off mute and ask your question? I can just, oh, go ahead. Great.
Yes, thank you very much. I would like to know how you would go about investors who would wish your model and design change to their interests, which would defy the business overall mission, goals, and purpose of starting it. How would you go about such an investor?
so and let me just make sure I have the question correct. It's how would you go about finding an investor who fits what you're doing and has a model that lines up with your company?
Yes, yes. They would wish you to design a business model that works for them, but rather changes the overall mission and purpose of the enterprise before they can invest in you.
Okay. So there's a couple things to unpack here. One is every founder is doing something different and has a different mission and different potential outcome. So, you know, if I'm a founder, I'm going to go onto the internet and start looking up potentially impact investors who invest in software in Texas that have this specific focus. And if I start narrowing down the scope of investors who are interested in my type of company, then it's more likely that when I talk to them, they'll understand what I'm doing and invest in me. I don't recommend changing what you're doing and what your plan is to fit what an investor is telling you. Because if you're changing your plan for someone else, you probably don't believe in it. And I've, you know, we've seen, and I've had conversations with founders who I love what they're doing. I know they're going to make money and be successful and make the world better, but they don't want to grow as fast as I need them to make my returns. And I could say, hey, you need to change your plan, but that doesn't actually influence how they're going to run the company and how they're going to operate. So it just leaves the risk for misalignment between what the founder wants and what the investor wants and what actually happens. That being said, if, you know, say I give you a piece of advice or a thought that inspires you to do an analysis about a business line, and after you do that analysis, you realize you're losing money by doing something, yes, feel free to change what you're doing, but don't change your entire plan because I tell you to do something. Especially because I don't know. All I know is how little I know, right? And I'm just one data point.
Thank you for that. Thank you. It's so helpful. Actually, we turned down the offer and moved ahead because we realized it was not the purpose. We started the company and that was not working for us. Thank you for that advice.
Virtual high five. It's awesome.
Does anybody else have any questions?
Yeah, can I ask now?
Yes. I just want to make sure that we address other people's questions as well.
Yeah, absolutely. That's why I didn't raise my hand again. Yeah, so I mean, it's more about the recommendation or the kind of communication you would have liked. Suppose you were in talks with a company like ours for investment, and with the COVID-19, the model that was first presented or we had forecasted won't work. I mean, let's be realistic about it. I cannot try selling an investor the same model or the plan that I had worked on before once this has happened, because the world has changed and things would change. And I still am in the process of figuring out what would that new model would be, right? So what sort of communication you should keep? I mean, or you would have liked for a prospective company to have with you over the course of time, and then explore the possibilities of having an investment?
Yeah, so it's a great question. I mean, we're in an unprecedented time that's like fundamentally changing markets and industries and life as we know it. But at the end of the day, we're going to come out of it in one way or another. And from my perspective, I fundamentally value radical transparency. And when I see an email update from a CEO saying, "Dear Investor X, this is how COVID impacted our company. This is our analysis about that, and this is how our plan to move forward in the future," that makes me feel really good about it, and reassures me that the founder is, you know, operating like a CEO and doing that analysis day to day. So certainly send out updates And it's not a bad thing to talk about what's not going well. So being transparent about it, but definitely stay in communication.
Yep. And is there a possibility for any sort of like, I know like investors have completely pulled back any new investments for now, but we do see some of the investment coming in still. So yeah, so I don't know if you can answer that, but if that could be a possibility, because we are also running out of cash, right?
Mhm.
Because, and you
Yeah.
don't know for how long you can survive. So during this time, is it a good idea to, push the investor a bit for raising funds? Because ultimately you're going to do the plan only when you survive, right? And
Yeah.
yeah, so.
Yeah. So it's a great question. And I think at a high level, again, there are certainly some investors who have completely pulled back, and there are some investors who are still investing. A couple of reasons why investors or some investors have pulled back. One, all of the investors who have current portfolio companies, they're focused on helping their current companies get through the crisis first. And another big reason, I have a friend who runs another fund. He's just never invested in a company without meeting the founder in person. So that's another reservation that some angels and VCs have right now. But we've invested in companies without having met founders in person. We're still writing checks, and there's plenty of folks who are. So it doesn't hurt to keep them updated and ask. There's another brief anecdote. So way back in the day when Airbnb first started, the founders bootstrapped the company themselves, and they kept trying and trying. And at one point, they almost ran out of money. So rather than quit, this was, I think, during the 2008 election, they printed out like fake Cheerios boxes and made like Obama O's. And then they sold those boxes and made enough money from that just to keep the lights on. So while it's important not to like detract from what you're doing in the long term to like distract yourself from growing a big company, scratch and claw and do whatever it takes to like keep your company going, even if it means part-time job or consulting or doing something on the side. That is, if you think your company can do well after COVID with the plan you have in place. Does that make sense?
Yeah. Thank you. Thank you for answering.
Yeah, of course. I know we're running out on time, so I just want to.
Yeah, I was just asking that. So.
Yeah, please reach out. Happy to help. Share your deck, give you feedback. Add me on LinkedIn. Yeah, happy to be a resource.
Awesome. Thank you so much, Mike. This was great. It was a really fun and interactive session. So thank you all for asking questions. I put a link to a form in the chat box. So it would be great if you could click on that. Just take a moment to review the session and let us know how it was. And the session is being recorded, so I'm going to stop it now.